Business survival. Look, if you're out of cash and out of credit, you're out of business. This is a quote from ex-Dragon's Den star Doug Richard, and it is so spot on. It's a brutally succinct way to sum up game over. Of course, in an ideal world, you would have both cash and credit, but short term, you can tread water or buy time with one or the other. As we know all too well, you won't find much help out there in the world at large right now. More than ever, it's down to you. The economy is at best flat, with risks from the Eurozone. People are not spending, banks are not lending, there are many costs still rising, and there is precious little government money in the form of both grants and real business support. But none of that matters if your organisation is designed to withstand these economic woes. For this, you need to have visibility on and proximity to your key numbers, and the instinctive feel for cash flow and the ability to take the right actions quickly. But I know that if you are in a real fight for survival, you might worry that it's already too late. So why not compare your situation with the following businesses? Take business one. The bank lost confidence in the directors and withdrew £600,000 of funding, more than half of their lending, in just 6 weeks. That much, that quickly, inevitably has a devastating impact. The bank had already made a £500,000 provision against their remaining exposure, so for them the hardest decision had in many ways already been made. For a manufacturing and contracting business, the finance systems were a little primitive, and the finance team's experience was no match for the catastrophic situation they suddenly found themselves in. There was also pervasive fraud within the factory, which, whilst known about, had been allowed to fester. And the owner had an overseas property, which was his only real pension, but it also doubled as his personal guarantee, and the bank saw this as their best hope of mitigating their losses. So we have the large-scale withdrawal of support from the bank, bringing the business to its knees within weeks, a very aggressive lender, financial systems that were fine when it didn't matter, but which fell woefully short when it did, finance people who had never seen the likes of this before, and combined with that, fraud. Or what about business two? Two guys had bought into a business that was in desperate need of rescuing after the original owner died some months earlier. They soon racked up sizable losses. Eventually, however, their sales and marketing strategy got some traction in their marketplace and sales took off. By this point, however, they found they had no money to fund the growth. The bank probably got things wrong from the outset with an overly generous £160,000 overdraft facility. When they suddenly woke up to the extent of their exposure, they found the balance stood at £170,000 in the red. They immediately cut the facility to £120,000. Now in the UK, worried banks commission what they call an independent bank review, or what is known as in the trade as an IBR. And they attempted to do a quick version of that here, simply to rubber stamp the closure of the business. So just as the business turns a corner, the bank gets cold feet. For the bank, it's just about going through the motions, but for the directors, of course, it's everything. Now, in the case of Business 3, this company had incurred £800,000 of losses in the 3 years since sales first took a dip and then just simply didn't recover. The bank was losing confidence, and with the relationship and overdraft both under pressure, they were passed to a section of the bank who could provide special support. Perhaps you've been sold this idea yourself before now. In fact, you're not sold the idea, you've really got no choice. But having taken this step, the bank then promptly decided to retain £120,000 of legitimate debit and credit card receipts, with their VAT due just round the corner. So what can I say? With trading conditions remaining tough, there were no magic bullets here available to help these guys stabilise their situation. So we have directors struggling to stem losses and experiencing very real cash pressures, and a bank that appeared to see this as an opportunity to get more fees while providing precious little by way of extra support. In the case of Business 4, they had plenty of work, but just weren't able to create a profit from it. Increasingly acute cash flow pressures were the result. Now, somewhat unusually, they had already managed to burst through every escalating VAT penalty threshold, and there were a good few of them. They also had payment plans in place for both PAYE and income tax. Indeed, in total they had in excess of £150,000 in unpaid taxes, now long overdue at a time they were making no money. Inevitably they found themselves at the limit of their overdraft, and their bank was unwilling and probably unable to do more. With only a bookkeeper internally and accountants externally who they knew were not equipped for this sort of thing, time was fast running out and the outlook was bleak. Business 5 had to contend with two of their key customers cutting the rates they paid them by 31% overnight, but in so doing looking to give this business lots more work at these drastically reduced prices. So no consultation, no scope for renegotiating service levels or to discuss any other terms. Nothing these guys could do. And the business's overhead cost base was already low. Behind the scenes, the bookkeeping was shaky and hard to make sense of, and financial information and forecasts were far too simplistic for a business that found itself in this state. The directors were faced with a defensive accountant ill-equipped to deal with the rapidly deteriorating cash flow, apart from vague ideas about cutting the already low overheads. When the business really needed help from their bank, which had been keen to lend them more money only a few months earlier, the bank refused, believing that insolvency was now inevitable. So these guys found themselves in the most unenviable of positions. Margins slashed, but with little scope to cut their own costs. No figures or forecasts they could trust to help them decide what to do in terms of the extra work they were now being offered, and above all, no time. Finally, Business 6. Some years ago now, but still highly pertinent. A company with a history of strong sales growth and consistent profitability, something that we have been conditioned to view as ideal. But this masked the fact that they had always been short of money and consistently fully drawn down on their invoice finance facility. They had been told by various different advisors over the years that their cash pressures would ease as they grew, but they didn't. In fact, they got worse. Until eventually they hit a crisis point. Clean out of cash, they took last-ditch, drastic measures just to keep the business afloat a few more days. Steps that they knew would blow up in their faces in little more than a week. So, these might strike you as extreme cases, and they were. But these businesses had one thing in common. They all had happy endings. In fact, 4 out of the 6 of them positively thrived. So here's the thing for you. If these guys could turn their businesses around from where they found themselves, frankly, anyone can. Our approach to helping these businesses get back on their feet is explained here in the Business Survival Blueprint. There are 4 key elements. The first is profitability. We show you step by step how to create a sufficient gap between your actual sales, however weak, and those you need to break even, and thereby guarantee better profitability. The second is pricing strategy. Learn the key pricing benchmarks you must adhere to in order to create long-term a sustainable business. When to accept work and when to reject it. Third, we have working capital. Look, it's critical to understand the impact this has so that you can ensure any profit you make translates into cash in the bank, because in most cases it simply doesn't, and this is something most people are completely unaware of. And fourth, cash flow. The key relationships you must track to ensure you don't drop the ball while you are making the other changes needed to generate cash from what you do. So, the Business Survival Blueprint. You'll find details below. Get the essential understanding you need to start taking action today.